Okay, so welcome to today's video. I'm going to be talking in today's seminar about the value of an audit. And in this introductory video, I'll cover why audits should have value, why they should be beneficial to investors and to other interested users. As a way of introduction, let me explain to you about the seminar outline for seminar number 2. Okay, so here are the learning objectives. So by the end of this seminar, these are the things that you should be able to do. For example, explaining the benefits from having an audit. That's what I'll cover in this video. There's some reading and viewing for you to do in advance of the class. So you need to read through the class questions on this seminar outline. You need to watch this video, okay, which is the one I'm recording right now. You need to view the video Q&A with James Doty. James Doty was the former chair of the PCAOB, and he made a comment that audits in the wake of the financial crisis were perceived to be largely irrelevant. So I want you to think about the things that he is saying in that video and also the possible solutions to this problem, okay, that he mentioned. This is also covered in this article in the CPA journal. So it'd be a good idea if you could read this article in order to answer question number 4. And then there are a couple of optional readings here as well if you're particularly interested in agency theory and the question of whether audit should be voluntary or mandatory. Okay, so that's the reading and viewing for today's seminar. The questions that we'll discuss in the seminar, question 1, I'll talk to you about principal-agent relationships. I'll give you 3 examples of principal-agent relationships, and we'll talk about why principals and agents have different objectives, why the principal faces information risk. Okay, so that's the purpose of question 1. In question 2, we'll be looking at the different systems in Europe compared to the United States for private companies. So in Europe, if you're a private company, if you're above a certain size, you have to have your financial statements audited, and those financial statements have to be made available to the public. In contrast, in the United States, private companies are not required to have an audit, and they do not have to make their financial statements publicly available. Okay, so I've got a question here about what do you think are the pros and cons of these 2 systems? And there's an article here from Accountancy Age which talks about this issue in the UK context. Okay, question number 3 is about the value of having an audit versus the value of having a review. So in the seminar, I'll talk to you about what the difference is between an audit and review and how much assurance you get from each and what the cost of each is likely to be. Okay, so there are 3 parts to this question that I want you to have a go at answering. And then question 4 is about the value of auditing based upon the comments from James Doty. Okay, so I have some questions here for you to consider. And then we'll wrap up with some multiple choice questions. Okay, all right, so that's the outline for the seminar. So let's get started. What are the learning objectives for today's seminar? Well, firstly, you should be able to explain the benefits from having an audit. So why is auditing beneficial? You know, that's a natural question to ask before we start the rest of the course, because obviously if audits don't have any benefit, then there's no real point to studying auditing, right? So there must be some benefit from having an audit. There must be some economic advantage. Secondly, discuss some pros and cons of allowing audits to be voluntary rather than mandatory. Okay, so should audits be voluntary or should they be mandatory? Thirdly, you should be able to explain the differences between a financial statement audit, a review of financial statements versus a compilation service. Okay, so we'll cover that as well. And then finally, comment on the concern of the PCAOB chair, or the chair at that time following the financial crisis, James Doty, that audits are largely irrelevant to investors. Okay, so these are the 4 things you should be able to accomplish from this seminar. Okay, so to get started, I'm going to talk to you now about the benefits of having an audit. Okay, now for public companies in the United States, and in fact in any country, public companies have to have an audit. So that is, audits are mandatory. They weren't always mandatory, however, okay? They became mandatory following the financial crisis of 1929. Okay, so you can see here an old newspaper article where it talks about the stock crash. Right? Wall Street is in a panic as stocks crash. So there was this big financial crisis. It was largely due to accounting frauds that this crisis occurred. And it was that actually led to the introduction of mandatory audits. Every public company was required to have an audit. But even before 1929, there were some companies that were purchasing audits on a voluntary basis. So that means there must be some benefit from having an audit, right? Companies were not always forced to have audits, but some companies were choosing voluntarily to have one. And indeed today, if you look at countries like the United States, where auditing is not mandatory for private companies, there are still some private companies that purchase audits on a voluntary basis. Okay, so again, the fact that they're purchasing it voluntarily suggests that they perceive some benefit from having an audit. Okay, so this kind of raises a question, well, what are the benefits from being audited? Well, the benefits really come from what is known as agency theory. Okay, so in agency theory, we have a principal and an agent, where the agent performs some action or service on behalf of the principal. So essentially the agent is working for the principal. In fact, in some cases, the agent might explicitly be hired by the principal. But both of these two parties are self-interested, right? The principal is self-interested and the agent is self-interested. So because the agent is doing something on behalf of the principal, the agent is self-interested as well. The agent may not act in the principal's best interest. Okay, that's the basic idea. Now, this theory is useful for thinking about the demand for all types of assurance services, not just for auditing. And as a future partner, you'll be able to use this principal agent theory to think about how to expand the range of assurance services offered by your firm. Okay, so in other words, you'll be able to think, okay, well, here's a situation where we have a principal agent problem, right? And so how can our firm provide assurance to help reduce this agency problem? So, you know, one reason why I'm going through this theory is that this theory can actually help you make money. It can help you think about how you would increase your range of assurance services, right? If you understand what the theory is behind the reason why we have auditing and why we have assurance services, then that can help you to spot opportunities in the market for selling more assurance services. So let's get into the theory. So in agency theory, you have an agent who performs some service on behalf of the principal. And there are two key assumptions in agency theory. The first one is that the principal has different objectives than the agent. Okay, so the principal is self-interested, the agent is also self-interested, but they may not want the same thing, right? If they have different objectives or different goals, then they don't actually have aligned interests. Okay, so it's that misalignment of goals or objectives that creates the agency problem. So that was the first assumption. And then the second assumption is that there is asymmetric information between the principal and the agent. So what does asymmetric information mean? Well, it means that the principal is not as well informed as the agent is, right? So the agent has more information than the principal has. And there are two particular types of information asymmetry. One is known as adverse selection. The other one is known as moral hazard. So under adverse selection, it's the situation where the principal doesn't know the agent's type. Okay, so for example, it might be the agent's type could be either honest or dishonest. Right? If the principal doesn't know the agent's type, doesn't know whether the agent is an honest person or a dishonest person, then that is a type of information asymmetry. Or it may be that the principal doesn't know how much ability the agent has, right? You could have a high ability agent and a low ability agent. And if the principal doesn't know which type of agent he's dealing with, then that can create what's called an adverse selection problem. All right, so that's the first type of information asymmetry. The second type of information asymmetry is known as moral hazard, and this is where the principal doesn't observe the agent's action. Okay, so with an action, we're dealing with things like effort, right? If we don't know how much effort the agent has exerted on behalf of the principal, then that means the principal has information asymmetry, right? The principal doesn't observe the agent's effort. Or it could be, you know, the principal doesn't observe some other action by the agent, right? For example, how much is the agent paying himself out of the principal's money? Okay, so moral hazard is basically to do with hidden actions, and adverse selection is to do with hidden types. But the basic idea is you have this asymmetric information problem. So that's the second assumption of the agency theory. Okay, so when you have this information asymmetry, that creates information risk for the principal. What is information risk? Well, it's the risk the principal makes a wrong decision because the information that the principal has is incorrect. Okay, so for example, the principal may hire an agent who's dishonest, right? That would be a wrong decision, and the reason he makes that decision is because he doesn't realize that the agent is dishonest. Okay, so that's information risk. It's a risk that the principal makes the wrong decision because of this information asymmetry. Now you might ask, well, what's the cause of information asymmetry? There are three causes. First of all, the principal may be remote to the information, right? So in other words, it's difficult for the principal to get well informed. So for example, if you think of a principal as being a shareholder, very often shareholders are not involved in a company's day-to-day business. In fact, the shareholder may not even be in the same country as where the company is. So that remoteness means that it's difficult for the shareholder to become informed about what the company's management are doing. It could be, the second cause is that the agent supplies biased information to the principal. Okay, so the agent, if the agent is the manager may overstate profitability to the principal. So why would the manager do that? Well, it may be that the manager wants to convince the principal that the manager is doing an excellent job in running the firm. Okay, so to the extent that the principal depends on the agent for information on the agent's performance, that may mean that the agent doesn't give reliable information. And then thirdly is simply the fact that for many situations, for example, many business, we have a high volume of information, and very often that information is very complex. So it's not easy for the principal to evaluate that information, right? If you have a large volume of transactions, for example, the company is involved in several million transactions in a year, and some of those transactions are complex. It's difficult for the principal to actually evaluate what the agent has been doing. Okay, so these are the three causes of information asymmetry. So it comes to the kind of selling point or the nub of the issue, right? Why do we have auditing? What are the benefits of an audit? Well, the audit doesn't change the objectives of the principal and agent, right? Instead, what the role of the audit is to reduce information asymmetry. So in other words, if I go back to these two assumptions here, an audit doesn't change this first assumption, right? It doesn't change the fact that the principal and agent have different objectives. Those are just given. But what auditing does is it reduces this information asymmetry, right? So if you can remove the information asymmetry, then you remove the principal-agent problem. So that essentially is the role of an audit, right? An audit reduces information asymmetry, that reduces the principal's information risk. So the principal is better informed about either the agent's type, in the case of adverse selection, or the agent's action in the case of moral hazard. Now, there are many different types of examples of principal-agent relationships. There are common ones that you may be very familiar with, like where the principal is a shareholder and the agent is a manager. But that's just one example of a principal-agent relationship. In reality, there are many other types of principal-agent relationships, and that can give rise to many types of assurance services that your firms can provide. Okay, so there are many situations where principals would like to have more information. And so if your firm can come along and help to reduce that information asymmetry, that's going to create value, right? So this demand for information to reduce information risk means that there's a demand for assurance. So the role of the auditor is to provide that assurance, right, to reduce the information risk that the principal faces. Okay, so in our first question that we'll go through in class, question number 1, we'll consider 3 different types of principal-agent relationships. The first one is where the principal is a shareholder, the agent is a manager. The second one, the principal is a senior manager, the agent is a company employee. And the third one, the principal is a bank, and the agent is a borrower. Okay, so what I want you to do is to, for each of these relationships, tell me first of all, why do the principal and agent have different objectives? So remember, this is the first assumption of agency theory, that they do have different objectives. So how are they different? So for example, why is a shareholder's objective different from a manager's objective? Remember, if they're not different, then we have no principal-agent relationship. We don't have an agency problem. So it has to be that they have different objectives in order for there to be a demand for auditing. So that's the first part, part A. And then part B, why does the principal face information risk? So in other words, what is it that prevents a shareholder, for example, observing the manager's type or the manager's action? Okay, and similarly, the second one, the principal is a senior manager and the agent is a company employee. Why does the senior manager face information risk with respect to either the type of employee or the action of the employee? And with the third one, why does a bank face information risk, right, with respect to borrowers? Okay, what types of borrowers may be unobservable to the bank, or what actions of the borrower may be unobservable to the bank? Okay, so that's question 1. That's where we'll start the seminar. All right, thank you for listening.